Three things are happening in the global economy right now at the same time that have never happened simultaneously before in modern financial history. Ray Dalio has a word for when markets disconnect this completely from the underlying reality. He calls it the quiet before, and he has seen enough cycles to know exactly what comes after the quiet. Today, Dalio explains all three of these things, why they are connected in ways most investors are not seeing, and what the convergence of all three means for every portfolio in America right now. Stay until the end. This one matters. Let's get into the video.
How does a market that is this close to all-time highs have absolutely no idea what is happening around it? That is not a rhetorical question. It is the specific analytical problem I want to work through with you today. Because the answer to that question is not that markets are stupid. Markets are not stupid. Markets are extraordinarily good at processing the information they are paying attention to. The problem is what they are not paying attention to. 50 years of studying economic history has taught me one thing above almost everything else about how major financial dislocations occur. They do not happen because new information suddenly arrives that nobody could have anticipated. They happen because information that was already available, information that was sitting in plain sight in government data and bond markets and commodity prices, finally gets priced in all at once after being ignored for months or years, in a repricing that feels sudden and shocking to the people who were not watching, but that feels perfectly logical and inevitable to the people who were. Right now, there are three things happening simultaneously in the global economy that the stock market is not pricing in. Not because the data is hidden, because markets are extraordinarily good at focusing on what is working and extraordinarily resistant to focusing on what threatens to stop working. Let me show you all three, and then let me show you why their convergence, the specific timing of all three happening at the same time, is the thing that concerns me most. The first thing, Japan's bond market and why it matters more than almost anyone in America understands. On January 20th of this year, traders in Tokyo described what happened in Japan's government bond market as pure chaos. Japan's 40-year government bond yield exploded to 4%, a level not seen in over 30 years. The 30-year yield jumped approximately 25 to 30 basis points in a single session, the largest single-day move in decades. And here is the number that should stop you cold. That chaos was triggered by a mere $170 million in 30-year bonds and $110 million in 40-year bonds, $280 million total, in a market worth $7.3 trillion. That tiny amount of selling in a market that large produced $41 billion in value destruction across the Japanese yield curve in a single session. And I want you to sit with that arithmetic for a moment, because it reveals something about the structural fragility of Japan's bond market that most American investors have never thought seriously about. Japan's government debt stands at 228% of GDP, the highest debt to GDP ratio among all developed economies, by a significant margin. For decades, Japan maintained the fiction that this debt was manageable because interest rates were kept near zero by the Bank of Japan's yield curve control policy. The government could borrow essentially for free. The interest burden was minimal despite the extraordinary size of the debt, and the debt kept growing. What changed in January was not the debt. The debt has been unsustainable for years. What changed was the political commitment to maintain the fiction. Prime Minister Sanae Takaichi announced plans to expand fiscal spending further, to deliberately weaken the yen, to push debt to GDP even higher in service of short-term economic stimulus. And the bond market, which had been politely pretending the existing debt was manageable, looked at the proposed additional debt and decided it was no longer willing to pretend. The yields exploded. The yen weakened. Treasury Secretary Besant called his Japanese counterpart as panic spread through global markets. The Federal Reserve took the extraordinary step of contacting currency traders, a move that almost never happens outside genuine emergencies. Now, why does Japan's bond market matter to an American investor sitting in front of their brokerage account? Because Japan is not just any bond market. Japan is the single largest foreign holder of United States Treasury bonds. Japanese institutions, pension funds, insurance companies, banks hold approximately $1.1 trillion in American government debt, and they hold it as part of a trade that has existed for decades. The yen carry trade, borrowing yen at near zero Japanese interest rates, converting those borrowed yen to dollars, buying higher yielding American assets, a trade that works beautifully as long as Japanese rates stay near zero and the yen stays stable. When Japanese bond yields explode, when the Bank of Japan is forced to raise rates to defend the yen and stabilize the bond market, the carry trade unwinds. Japanese investors sell American assets, particularly American treasuries and American stocks, to buy back yen and repay their yen-denominated borrowings. That selling creates upward pressure on American treasury yields, which creates downward pressure on American stock valuations, which creates exactly the kind of externally driven dislocation that the American market is currently sitting completely unprepared for. The January event was the warning. It was not contained because the Bank of Japan intervened, but the underlying fiscal problem has not improved. It has worsened. And every analyst I trust who watches the Japanese government bond market closely believes the January event was not the end of the story. It was the beginning of it. The second thing, America's oil reserve is effectively gone, and almost nobody is talking about it. 3 days ago, the United States Strategic Petroleum Reserve fell below 300 million barrels for the first time since January 1983. Let me give you the full picture because the numbers are genuinely staggering when you see them in sequence. Before the United States and Israel attacked Iran on February 28th of this year, the SPR held approximately 415 million barrels of crude oil. President Trump authorized the release of 172 million barrels to cushion the economic impact of the effective closure of the Strait of Hormuz. The SPR has been declining at a rate of 6 to 10 million barrels per week since the Iran conflict began. As of this week, the reserve holds 298.7 million barrels, down from 415 million barrels in February, a decline of 116 million barrels in approximately 5 months. But the raw number understates the problem, because a Government Accountability Office report from July found that the SPR's infrastructure has degraded to the point where it can only draw down oil at 61% of its intended rate, and it can only accept returning crude at 56% of its design capacity. In plain English, the emergency reserve that is supposed to protect America from energy shocks is smaller than it has been in 40 years. It works at barely half its intended capacity. And the government has already authorized the release of a total of 172 million barrels out of the approximately 300 million that remain. When the release Trump authorized is completed, the SPR will hold approximately 243 million barrels against a minimum safe operating level of 70 million barrels, with infrastructure so degraded that it cannot respond quickly, even to the reserves that remain. Now, here is the connection that most financial analysts are making individually, but not putting together clearly enough. The Strait of Hormuz, through which 20% of the world's globally traded oil flowed before the Iran conflict, remains disrupted. The conflict is not fully resolved. The shipping disruption continues. And the emergency buffer that America built specifically to handle exactly this kind of supply disruption is now effectively gone. Oil analysts are warning of what they call a violent repricing, when the market fully processes the implication of SPR reserves at 40-year lows, combined with ongoing Middle East supply disruption. A sudden spike in oil prices of the kind that depleted reserves combined with disrupted supply can produce hits the American economy as an inflation shock at exactly the moment when the Federal Reserve's ability to respond is most constrained. More inflation means more rate pressure. More rate pressure means more stress on the $39 trillion federal debt. More stress on federal debt means more pressure on the bond market. More pressure on the bond market means, and here is where the third thing comes in, a stock market that has been ignoring all of this suddenly has to price it in. The third thing, stocks at all-time highs while the world changes around them. How is the stock market near all-time highs while all of this is happening? The answer is the same answer that explains every significant market disconnect I have observed in 50 years of studying markets. Human beings are extraordinarily good at extrapolating the recent past into the future. And the recent past for American stocks has been very good. The AI narrative is powerful. Corporate earnings have been resilient. The Federal Reserve has signaled that it will not allow a severe recession. The fundamental assumption embedded in current valuations is that the environment that has produced recent gains will continue to produce them. This is the machine working exactly as designed, not the economic machine, the psychological machine, the one that tells investors that the trend they are experiencing is more likely to continue than to reverse, the one that makes the recent past feel like a reliable guide to the near future, even when the near future contains developments that have no precedent in the recent past. Three things with no precedent in the recent past are happening right now simultaneously. Japan's bond market is showing structural fragility that could force the largest foreign holder of American Treasury bonds to liquidate its American asset holdings at a time when American fiscal needs have never been greater. America's emergency energy buffer has been reduced to its lowest level in 4 decades, at precisely the moment when the Middle East supply disruption that required that buffer has not been fully resolved, and the CAPE ratio of the American stock market is above 37, higher than it was in 1929, higher than it has been at almost any point in the last 150 years of market history. The valuation that assumes everything goes right forever in an environment where three major things are going wrong simultaneously. I have a specific word for this kind of market situation, not a prediction, a diagnosis. The word is fragile. A market is fragile when its current price level requires everything to continue working as expected, and when the number of things that could stop working is unusually large. The fragility is not in any single risk. It is in the combination, the convergence of risks that are individually significant and collectively unprecedented. Why the convergence is the thing that matters most. Let me explain why I am more focused on the convergence than on any individual risk. Because this is the part of the analysis that I think is most underappreciated and most important. Each of the three things I have described is significant on its own. A Japan bond market crisis would be significant. An oil price shock from depleted SPR reserves would be significant. Overvalued stocks in a weakening fundamental environment would be significant. But historically, the crises that produce the most severe market dislocations are not the ones driven by a single large shock. They are the ones where multiple pressures, each individually manageable, arrive simultaneously and amplify each other in ways that the financial system cannot absorb. 2008 was not just a housing crisis. It was a housing crisis that revealed leverage in the banking system, that revealed counterparty exposure, that revealed liquidity problems, that revealed a Fed that was operating at the limits of its conventional toolkit simultaneously. Each problem would have been manageable alone. Together, they created a feedback loop that nearly took down the global financial system. The convergence I am watching right now has a similar structure, not identical, but similar enough that the template applies. A Japan bond market disruption forces yen carry trade unwinding. Yen carry trade unwinding pressures American Treasury yields upward. Higher Treasury yields increase the interest burden on 39 trillion in federal debt. The federal government responds by issuing more Treasury bonds to cover the higher interest cost. More Treasury supply at higher yields pressures bond prices further. Bond prices falling means the unrealized losses on bank balance sheets grow. Growing bank balance sheet losses tighten credit conditions. Tighter credit conditions slow economic activity. Slower economic activity at a moment when oil prices are spiking from depleted reserves creates stagflation. Stagflation is the environment where the Federal Reserve cannot cut rates to stimulate growth because inflation demands higher rates. And a Fed that cannot cut rates cannot provide the rescue that the stock market at these valuations is implicitly counting on. I am not predicting that all of these dominoes fall in sequence. I am showing you the sequence that the current setup makes possible. The path that connects Japan's bond market to your retirement account through oil prices and federal debt and bank balance sheets and Federal Reserve constraints. Most investors are looking at their brokerage account and seeing a number that is near its highs. They are not seeing the fragility of the environment that produced that number or the number of things that would have to continue going right for it to stay there. What to do in a fragile environment? The all-weather answer. A fragile environment does not require a dramatic portfolio overhaul. It requires honest assessment of what you own and what the specific risks in the current environment mean for each position. The question I ask about every position in a fragile environment is simple. Does this position require everything to keep going right in order to hold its value, or does it have inherent resilience that survives the scenarios where things go wrong? Cash and long duration bonds require the interest rate environment to remain stable. In an environment where Japan carry trade unwinding pushes yields higher and oil shocks push inflation higher, these are among the most vulnerable positions. Highly valued growth stocks require earnings growth to continue uninterrupted and interest rates to remain contained. In the environment I am describing, both of those requirements face direct challenge from the three things happening simultaneously. Real assets that produce income, that adjust their revenue with inflation, that hold their value when paper currency loses its credibility, these are more resilient, not immune, more resilient. Gold specifically benefits from the convergence I am describing in a way that almost no other asset does. A Japan bond crisis weakens faith in sovereign debt broadly. Gold benefits. An oil shock drives inflation. Gold benefits. A Federal Reserve that cannot raise rates aggressively because of the debt burden. Gold benefits. Dollar weakness. From all of the above, gold benefits. The old ends up. I am not telling you to sell everything and buy gold. I am telling you to look honestly at what you own. Assess whether it is positioned for a fragile environment or an environment where everything keeps going right, and make the adjustments that honesty demands. The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. They assume the world will continue to be what it has been. The world that produced the recent past of American stocks, the world of stable Japanese bond markets and abundant oil reserves and manageable federal debt and unlimited Federal Reserve flexibility. That world is being replaced by something else. Something where three things that never happened simultaneously before are happening at the same time right now. The market has no idea yet, not because the information is hidden, because markets are extraordinarily good at believing the recent past will persist until it does not. And when the gap between what markets believe and what is actually happening closes, it closes fast. The question is not whether you will see it happen. You will. The question is whether you will have positioned yourself before you see it or after. Before is considerably more comfortable.
Japan's bond market, America's oil reserve at a 40-year low, stocks near all time highs through all of it. Dalio's diagnosis is one word: fragile. A market that requires everything to keep going right in an environment where three major things are going wrong simultaneously. The gap between what markets believe and what is actually happening is not going to stay this wide forever. It never does. Your action this week. Look at every position you own and ask one honest question: does this require everything to keep going right? Or does it hold its value if even one of the three things Dalio described gets worse? The answer to that question is your real risk assessment, not the one in the quarterly report your advisor sends you. If this connected dots that were not connected before, share it with someone who is looking at their brokerage account and seeing a number without seeing what is underneath it. And I'll see you in the next video. Bye.